Welcome to Morningstar. REITs are a popular inflation hedge and a potential source of stable income. While this may sound like a safe bet for everyone, investors should remember that different REITs come with unique risk profiles. With the recent currency moves, we are asking Xavier Lee, equity analyst at Morningstar, about the impact on Singapore REITs. Hi, Xavier. How do Singapore REITs fare amid surging inflation, a strengthening local currency, and a volatile foreign currency market?
Hi, Kate. Thanks for having me. Yes, Singapore's monetary policy response to combat imported inflation is actually to appreciate the Singapore dollar. This has resulted in the Singapore dollar appreciating more than 10% against major currencies such as the British pound, as well as the euros, and more than 20% against the Japanese yen. So needless to say, we think that Singapore REITs that are invested in countries with currencies that have weakened against the Singapore dollar may face lower distribution per unit and net asset value when the foreign source income as well as the asset values gets translated back to the Singapore dollar. So while Singapore REITs may use a mixture of foreign currency contracts as well as natural hedging to manage this foreign currency risk exposure, we see this as a short-term fix that helps to dampen the impact of foreign exchange movement. Once the hedges roll off, the REIT will still face potential erosion of its distribution per unit, as well as lower net asset values if the Singapore dollar were to remain at current levels.
So what can REITs investors do to reduce or hedge against such risk?
So as currency markets remain volatile on the back of the central bank's ongoing battle with inflation, as well as heightened geopolitical risks arising from the ongoing Russia-Ukraine war, we actually continue to like Singapore for its political stability and the pro-business government that has earned the country its reputation as a safe haven for investors and businesses. Both the near-term and long-term outlook for Singapore real estate remains positive, driven by the economic recovery from the borders reopening, as well as the limited land supply as Singapore's small city-state. Hence, we think that investors should look for Singapore REITs with a Singapore-centric portfolio, as we believe it will be a safe refuge for investors to park their money in times of uncertainty. That said, we are not telling investors to avoid Singapore REITs with overseas assets on the basis of foreign currency risk exposure. Singapore REITs that have ventured overseas can actually achieve geographical diversification and help to reduce any concentration risk to any single country's economy. So, what we are saying is that investors should seek a wider margin of safety when investing in Singapore REITs with significant FX risk exposure, such as the demand for a higher distribution yield to compensate for the underlying foreign currency risk that they are taking.
Right. So what is your top Singapore REIT to pick right now and why?
Our top pick for office and retail is CapitaLand Integrated Commercial Trust for its Singapore-focused, diversified portfolio of high-quality retail and office assets. As I shared earlier, the overall outlook for Singapore real estate remains positive, with strong office demand underpinned by workers returning to their offices and recovering retail demand from the return of tourism here. This should both translate to positive rental reversions for its office buildings and malls in the coming year, helping the trust to achieve a distribution per unit growth of 7% next year. As for logistics and industrial REITs, our top pick is ESR Logos REIT for its Singapore-centric portfolio that shields it from foreign exchange risk exposure arising from the diverging monetary policies across the rest of the world. At an 8% forward dividend yield, we think the trust is trading at a generous spread above the 10-year Singapore government bond yield of 3.5% and offers a better risk-adjusted return at current prices when compared with its peers.
Wonderful. Thank you so much. For Morningstar, I'm Caitlin.